How can I simplify the tax implications of corporate bonds? Imagine earning steady income from bonds without the headache of complicated taxes. That's what understanding the tax rules around corporate bonds can do for your passive income plan. First, remember that the interest payments you get from corporate bonds are taxed as ordinary income. This means they are taxed at your regular income tax rate, whether you receive them twice a year or quarterly. Keep track of each interest payment so you can report it accurately on your tax return. Next, think about what happens if you sell a bond before it matures. If you sell it for more than you paid, that profit is called a capital gain. If you sell for less, it's a capital loss. The tax rate on these gains depends on how long you held the bond. If you held it for less than 1 year, the gain is taxed at your regular income rate. If you held it longer than 1 year, the gain qualifies for a lower long-term capital gains tax rate. Now, consider bonds bought at a discount. Sometimes, you can buy a bond for less than its face value. Over time, the bond's value increases to its face value, and this increase is called accretion. You may need to report this increase as ordinary income each year or when the bond matures. This process makes sure you pay taxes on the gain gradually rather than all at once at the end. To make tax handling easier, keep detailed records of your bond purchases, interest received, and sales. Use software or consult a tax advisor to help you calculate the interest income and any accretion properly. Holding bonds in tax-advantaged accounts like individual retirement accounts or 401(k) plans can also help. Inside these accounts, interest income and gains are either tax-deferred or tax-free, reducing the complexity of tax reporting. If you want to keep things simple, consider holding bonds for more than 1 year to benefit from lower long-term capital gains rates. Always report interest income as ordinary income, and be aware of how bond discounts are taxed. Using tax-advantaged accounts and keeping good records can make your bond investments easier to manage come tax time. This way, you can enjoy a steady stream of passive income without the stress of complicated tax rules.